Okay, hello everyone. This is Lisa Ruggiero. I'm a program coordinator at the Syracuse University Environmental Finance Center. On behalf of the Environmental Finance Center Network, I'd like to welcome you to our webinar entitled Financial Health Checkup for Water Utilities, using the new free Spreadsheet tool. I will be providing some technical support for today's session. Please take a moment to observe your GoToWebinar control panel. Most of the functions are self-explanatory, but I'd like to draw your attention to the questions section there. During today's session, you will all be kept on mute to ensure audio quality and minimize background noise. Should you have a question, please type it into the GoToWebinar question dialog box at any time. We will be holding all questions until the end of today's presentation to ensure that we end on time. We have over 270 registrants for the webinar today, and we will try to get to as many questions as we can. Any questions that we can't get to today, we will follow up with you individually via email. Our presenter today has consented to share his presentation slides with you. We've actually already posted the PowerPoint slides as well as a link to the tool on the webinar page at efcnetwork.org. We're also going to add a link to a video recording of today's webinar, but please allow up to 1 week for the processing and posting of this resource. Okay, and just to give you all an idea of where others on the webinar are tuning in from, we have prepared this map. You can see that attendees are spread from all across the United States, including Alaska, Hawaii, and even internationally from Canada and South Africa. Thanks to you all for joining us. And I'll also take this opportunity to thank AWWA for assisting with outreach and for providing CEU credits for today's webinar. This session is one of several webinars conducted by the Environmental Finance Center Network for the Smart Management for Small Water Systems project. The EFCN provides training and technical assistance to small public water systems in all 50 states and 5 territories to help local water systems achieve and maintain compliance with the Safe Drinking Water Act. Workshops, trainings, and direct assistance are provided on the topics you see on your screen, and you can sign up for direct assistance anytime at efcnetwork.org/assistance/request assistance. And now it is my pleasure to introduce to you our trainer for today, Mr. Shadi Eskaf. Shadi is the Senior Project Director at the EFC at the University of North Carolina, Chapel Hill. He's going to be walking you through a financial health checkup for water utilities. And at this point, Shadi, I'll turn it over to you.
Thank you very much. Thank you everybody for logging in and for attending this webinar. I am Shadi Eskaf, as Lisa just mentioned, and I am available to answer any of your questions at the end of the webinar. But please, during the webinar, as you think of questions, please post them. And I know that Lisa and Laura are taking care of looking through those questions, making sure that we can answer them towards the end. The objectives for today's webinar will be, I'd like for you to leave the webinar knowing these 3 things, knowing how to translate data in your financial statements into indicators that assess the overall financial health of your utility fund. I'm assuming everybody here either is working with a water utility or for a water utility. And if you're a regulator or a technical assistance provider or consultant, you're working with water systems, and financial management is a critical part of providing service to customers. So this is going to be an overall, a broad overview of the financial indicators that are mentioned in the tool, but I won't be going into much detail to every single one of them. And I'll explain that in a few minutes. The second objective I'd like to make sure that we achieve is that you leave this webinar knowing and being familiar with this new tool that we have up that's called the Financial Health Checkup for Water Utilities. And the last thing is also so that you'll be able to interpret the indicator values to determine the strengths and weaknesses of the utility fund based on the results that you see from this tool. Financial indicators are really there to help answer important questions that you might have that might keep you up at night. So if I ask any utility right now, or anybody who's in financial management of any organization, but focusing on utilities, is your system self-sufficient? Do you already know the answer to that question? You might have a gut feeling, but do you have the hard data that can justify, can back up your assertions? Are you able to cover your debt service after paying for day-to-day operations? So do you have enough cash to pay for debt service as well as operations and maintenance? If your customers stop paying their bills, if you don't have revenues coming in every month, or if you have seasonal revenues, how long can you keep maintaining operations based on the cash that you have available? Can your system meet its short-term obligations? How much of your system's expected life has already run out? Are your assets depreciated so much that you need to be replacing those assets more aggressively than you have in the past, or is your system relatively new? So those are general questions. These are, some of these are almost managerial questions, and financial indicators can help answer those questions. As I mentioned, I won't be going into every individual indicator in a lot of detail. We have a whiteboard video that explains each of these indicators in lay terms, giving the example of a man who owns a car and how he's paying for his car and maintaining his car. So we're equating the water utility with car ownership. This whiteboard video is posted on the Water Research Foundation website, but it's available for everybody. It's out of their firewall. And I'm providing the link here on the PowerPoint slide. As Lisa mentioned, the PowerPoint slides are already up on the web, so you can download them and have access to the whiteboard video. In addition, my colleague at the EFC here, Glenn Barnes, had a webinar, presented a webinar specifically on key financial indicators a few months ago. We have that recording also up at this link, as well as the links that you'll see next to the tool. So if you're interested to listen in on what he presented on each of these indicators in a little bit more detail than what I'll go over, then please feel free to do that. He also wrote a few blog posts, one blog post per indicator, and I'm providing links to each of these blog posts in here. So I'm going to provide a quick review of the key financial indicators ahead of presenting the tool itself. And while we're talking about the tool, we'll be explaining a little bit more in detail some of these indicators. But there are 5 specific indicators that you see on the screen here, and we'll go over all 5 of them. The operating ratio one, we actually have 2 different versions that I'll explain as we go along. So the first question that we ask is your system self-sufficient? That's the overall goal for any enterprise fund, is to make sure that the revenues coming in are enough to support all of the expenses going out, and there's no cross-subsidization from any other kinds of funds. So you don't want to have regular transfers from the general fund into the water fund unless it's for providing for paying for services. The ratio for that is the operating ratio. And that's just looking at the total operating revenues divided by your total operating expenses. You want your revenues to exceed your expenses, so this ratio should at least be 1.0. This assumes that water utilities revenues are mostly coming from your operating revenues. Operating revenues things are the base charges, the minimum charges, the volumetric charges, basically the monthly bills that you send out to your customers. For most utilities, that generates about 90 to 95% of all of the revenues that the utility gets. So an operating ratio is really enough to show the majority of your revenues, are they enough to pay for your operating expenses? I mentioned that this operating ratio can be calculated in 2 different ways, and it really comes down to whether or not you include depreciation in your operating expenses. When you don't include depreciation, when you're looking at operating expenses and you subtract out of that depreciation, what you're doing is you're looking at the day-to-day cost of operating and maintaining the water system. So really this operating ratio is looking at whether or not the revenues coming in that year were enough to pay for day-to-day O&M costs. If you include depreciation into the denominator, then you're asking the question, are your revenues enough to pay for your day-to-day O&M expenses, as well as putting some money aside to help offset the depreciation of your physical assets in order to be able to replace them in the future? Now, this is a tricky thing to try to describe in a minute. Glenn Barnes did a very good job of explaining that in his webinar as well as the blog post. I'd be happy to take questions about depreciation. If you haven't attended the previous webinar, please submit a question on that, and if we have time towards the end, I can explain that. But essentially, we're using depreciation here as a surrogate for capital expenses. In the case that you don't already have a capital improvement plan and you don't know how much money you need to be setting aside every year to pay for capital costs, well, depreciation is really sort of a lower bound, a minimum amount that you should be setting aside in addition to the funds that you need for O&M expenses. The second indicator answers this question: are you able to cover your debt service after paying for your day-to-day operations, which is your O&M expenses? And the ratio for that, or the indicator for that, is debt service coverage ratio. This is looking at the net revenues, so taking the operating revenues, subtracting out of that the operating expenses, excluding depreciation. So again, we're just talking the O&M costs part of the expenses. So you have the net revenues at the top, and then in the denominator you have your principal and interest payments for debt service in that year. Since you want your net revenues to exceed your debt service in order to be able to pay for O&M as well as principal and interest, you want this ratio to be above 1.0. But that's not really the full story, because funders and bond covenants would sometimes specify a higher ratio for this indicator. So bond covenants might actually, they very often say they want a debt service coverage ratio of 1.2 or higher, meaning that they expect, the funders are expecting that the utilities are generating net revenues, or revenues to cover O&M expenses, principal and interest payments, as well as an additional 20% extra, which is used as a buffer for lean years, as well as to pay for future capital expenses that debt service is not covering. So the ratio here is usually higher than 1.0. The indicator to answer, can your system meet its short-term obligations, is sometimes called current ratio and sometimes called quick ratio. It really depends on how you're calculating the numerator. What this is looking at the current assets of the water system or the water fund and seeing if that exceeds your current liabilities. We exclude a few things in both of these, in the current liabilities and the current assets. So we're not looking at total current assets and total current liabilities. Sometimes the current assets include some restricted funds, or they might include inventories and prepaid items. Those are assets that you currently have, but they're not really available to pay for short-term liabilities. So we exclude them in order to assess the portion of your current assets that are essentially cash or unrestricted assets that you can dip into as soon as you need to pay off your current liabilities. The same thing with current liabilities. We exclude things like refundable deposits or bond anticipation notes. Bond anticipation notes are paid off once you actually receive the bonds, so you're not going to use your current assets to pay them off. And refundable deposits, we're never really sure how much of that you're expected to be returning to the customers in that year, so we exclude them, assuming that they can be covered using your other assets. And it's not usually a big portion of your total liabilities. The current liabilities usually include other things. If your customers stop paying their bills, if the revenues coming in slow down, how long can you maintain your operations? This one, I like this indicator title because it actually explains exactly what it is. It's days of cash on hand. It's the days of O&M expenses that you can pay using the cash that you currently have on hand. So we're dividing the unrestricted cash and investments, or cash and cash equivalents, by an average daily O&M expense. And the O&M expense, again, is operating expenditures, or operating expenses excluding the depreciation and amortization. If you divide those two numbers up, then you actually get a number of days. So a utility might see that this number says 121, which means that if they have no more cash coming in, they already have 121 days of cash, or they have enough cash on hand to pay for 121 days of average O&M expenses before they run out of their unrestricted assets. How much of your system's expected life has already run out? This one, depreciation schedules. Now, the caveat here is there's a difference between physical asset depreciation as well as the accounting way of calculating depreciation. When accountants calculate depreciation, they assume specific expected life spans for different kinds of assets. They might think a pipe will last 20 years, so they will depreciate that asset over a 20-year period. But as you know, in the field, things are not always following rules of thumb that way. You might have pipes that last 50, 60 years and they're still operating fine. But you also might have some pipes that last only 10 years, depending on the hydrology and geology of your area. So if you believe that the accountant's way of depreciating assets follows closely to the physical depreciation schedule or the actual lifespan of the assets for your utility, then this is a really good indicator to assess the overall age of the system and how quickly you need to be replacing your assets. And we calculate this by taking the accumulated depreciation of all of the assets that are depreciable, which are your equipment, your buildings, and we divide it by the value of those assets, of the depreciable assets, the plant and equipment. I'll be showing some examples of this when we go through the tool and pull out specific numbers from financial statements, which actually leads me to this slide, which is where do we get this information? And the indicators sound useful, but if you don't have the data to support them or to be able to calculate what you need for your indicators, then they're useless. For local governments, the good news is all of this information you already should have in your audited financial statements. As long as your financial statements are following GASB rules, then you've got every single one of the numbers that you need to calculate these ratios. And I'll show you specific examples in this webinar. For non-governmental units, you aren't reporting using GASB rules in most cases. So balance sheets or shareholder reports, annual reports often have numbers that are close to some of these things. When we're talking about total operating revenues and operating expenses, those are usually some numbers that you would see in other types of reports that non-governmental utilities also generate. So we have been working with a lot of water systems, especially small water systems across the country for the past few years. And one of the services that we provide is to assess the overall financial health of the utilities. And we've typically done that by asking the utilities to send us their financial statements and helping interpret those numbers directly with the utility on the phone. And we realized that this is something that can be done just through a use of a simple spreadsheet that the utilities can download and do on their own and update every year on their own. So we've generated this tool and we've posted it earlier this week that we're calling Financial Health Checkup for Water Utilities. It's an Excel-based tool. It doesn't run off of macros or anything like that. It's just simple calculations. And it has, you will see in a minute, specific areas where you would input information, and then it provides all of the calculations for you and all of the graphics that show you how the indicators have trended in the past few years. It's a free tool. Anybody can download it and use it. We especially encourage water utilities, especially small water systems, to download and use this. Regulators, consultants, technical systems providers, anybody can use this tool with no restrictions. And the links for the tools, you can download the tool either from the EFCN network website, which is efcnnetwork.org, or through the EFC at UNC's website, efc.sog.unc.edu. Again, these links will be provided to you in the PowerPoint slide that you can download from the page that you went to register for this webinar. Before I demonstrate the tool, I will mention a quick tip. When you download the tool for the first time from the website, be on the lookout for this yellow bar that you will see at the top, which says that you've downloaded this file from the internet. Do you trust it? You have to hit enable editing in order to be able to use the tool, otherwise it will appear to be frozen. So at this point, I'm going to switch over to demonstrate the tool, and we're actually providing the direct link to the tool right here in case you don't want to navigate through our website. But I'll show you how to get to it from the EFC at UNC's website as well. All right, let me switch over to, if you go to efc.sog.unc.edu, right now you can see it as one of the featured work on the home page, but this list changes over time. So the best way to do it is to click on resources, or to hover over resources and then click on tools, and you'll see several tools in here that might be useful to you. We have, for example, a water and wastewater rates analysis model, which calculates, which helps you project your revenues from rates that you set. We have a lot of tools here that we've demonstrated those tools through previous webinars as well. At the very top, you'll see right now financial health checkup for water utilities. If you click on that, you'll find the web page that describes the tool, how to use it. We also have the link, the whiteboard video that I mentioned earlier, explaining financial indicators in lay terms, available here, and hopefully we'll be posting a recording of this webinar on the same web page. At the very top, you'll see the file. Click to download. It requires registration, and we just need your name and email address and organization, and we only use this not for marketing purposes, but in order to notify you whenever there's an update to the tool. So when we have a new version of the tool available, we will email people who've downloaded the older ones to let them know that there's a newer, hopefully better version available for access. And sometimes we will email to mention that we've developed a new tool that supplements a different tool that they've downloaded as well. So we're trying to provide as many tools as possible for water systems. Once you're here, you click on download and you'll be able to see and to get the Excel file. I've already got the file available, so I just open it directly right now. The first thing that you'll see is an instructions page with information about what the tool is and the features. Again, the link to the financial indicators whiteboard video and some color-coded instructions on where to go for specific things. If you have comments about the tool, suggestions, feel free to click on this link to email me directly, and we're happy to take suggestions because we would like to update this tool to make it as useful as possible for water utilities. The tool has several navigation buttons, so any arrows that you see, of any of these green arrows, if you click on them, it will take you to the next page, or it will take you back to the previous page as well. You'll see down here also worksheets with the color codes that match the instructions up here. So let's begin, and when you download it, you'll find this tool already pre-populated with numbers, and that's just to show you an example of how to interpret the rate sheet, the financial statements, and to input the data in here. And you can actually see, if you go down here, you can see an arrow that says View Example Statements. If you click on that, you'll see an example of an audited financial statement from a utility where we show calculations. We show specifically line item 7 comes from this spot right here. The cash and cash equivalents is number 7. Number 5 is A minus B and C. But we show examples from an actual financial statement in the tool, and it corresponds to these items right here. So you would just put in the appropriate numbers directly into the cell. So we try to make this as simple as possible, where if you already have your financial statement, you can just find specific line items and type in those numbers directly into this tool, and the tool will calculate those ratios for you. The next page is where you would see financial indicators. So again, all the ones that we mentioned, operating ratio, both with and without depreciation, debt service coverage ratio, quick ratio, days cash on hand, and the percent of capital assets depreciated. For this one, we actually have, these are all hyperlinked, so you can click on any one of them and it will jump down to the appropriate section, or you can just click down here and scroll up and down until you get to the right indicator. But there are 6 indicators in here, and all we need from you on this worksheet is to specify what the ratios are, so what the targets are that you would like to see your water fund achieve. So I mentioned that the operating ratio, at the bare minimum, you want to be 1.0 because you want your revenues to exceed your expenses. And we show the formula here as a reminder, and also the link to Glenn's blog post about this indicator. So you have the resources here to read again on each of these indicators. We also try to explain it in terms of just plain English. What is this indicator trying to do, both in terms of a simple question, did you generate the revenues needed to pay for O&M and a little bit for capital? So this is the operating ratio including depreciation. And also a little bit more in detail in terms of what exactly is this indicator trying to do. So it measures the profitability of the water and wastewater system. It shows the utilities revenues from sales, which again is the customer bills, whether or not they're sufficient to cover your O&M costs, as well as depreciation used as a surrogate for capital needs. On the right here, you'll see each of the questions written up here, so you can equate each of these indicators with a simple question. So if you set a target that's higher, what this tool is doing is it's taking a look at the numbers that you've input in the previous worksheet. It's calculating the ratio, and it's comparing that ratio to the indicator. So in this example, for this town, in fiscal year 2014, their total operating revenues were $2.5 million, and their total operating expenses was $2.7 million. The ratio in that year was 0.91. When you take the revenues divided by expenses, it comes out to be 0.91. 0.91 happens to be below the target that we set here of 1.2. Because of that, the color turns red. You see an X right here showing that this system did not meet the target. And we also show, because you've got 5 years worth of numbers, so we start off with 2014 and we go back 5 years, it will show you whether or not this ratio has improved or not in the past year, so between fiscal year 13 and 14 for this system. In this case, it didn't really change very much. It was plus or minus a small margin. And it shows you a trend line for the past 5 years on what the operating ratio looked like. You can click on this link to take you directly to the graph that shows you this trend line in more detail. Or you can click on the green arrow at the top that says Step 3, View the 5-year trends, and it takes you to the page it has, which is down here, has all 6 indicators together. So on this page, the dotted lines that you see for each indicator, let's just talk about the operating ratio including depreciation, that blue dotted line is the target that we set in the previous worksheet. So if we disagree that 1.2 should be the target, we can go back and edit that back to 1.0. And by doing that, the target now dropped down to 1.0, and you can see whether or not the system was able to achieve that target. For all of these graphs, you want to have your funds numbers or your black line on top of or above this blue dotted line. Everything above is good. Everything below means it needs improvements. It didn't meet the target. And we have the key up here that explains that as well. So in this case, for this example utility, they were able to meet their 1.0 target for the operating ratio in fiscal years 10 and 11, but since fiscal year 12, they've been below that target. So they haven't been generating enough revenues to pay for O&M expenses as well as depreciation, which again is being used as somewhat of a surrogate for capital expenses. For the other ratios though, operating ratio not including depreciation, so whether or not revenues were enough to pay for O&M expenses alone, they were always above the dotted line. So they were able to balance their budget. Debt service coverage ratio jumped around a little bit. I think partly because they might have had new debt come in, but would have to dig a little bit deeper to find that out. But they were able to generate enough revenues to pay for O&M as well as debt service in 3 out of the past 5 years. Trends are very useful because if you see lines going upwards, then that gives you a sense of a little bit more of security, especially if you're below the line and you're trying to get to that target. You want to see that you're trending upwards. But if you see things where the ratios are trending downwards, it means that if you don't change the way that you're either charging your customers, change your rates, or change the way that you are controlling your costs, or change whatever aspect it is that's causing the trend line to decrease, then at some point you will drop below the target that you have. So for example, in the percent of capital assets depreciated for this utility, that trend line just kept going downwards, which means that if they don't change their practices, their assets will continue to keep depleting over time faster than they're able to replace them. So at some point, they will have a water system that has a lot of assets that are near the end of their life and quite expensive to try to replace all at once. Usually you'd want to try to see this trend line being somewhat flat, or if it's trending downwards, just not very steeply, so that you're able to generate the revenues that you need to be able to replace those depleted assets at some point. We have example statements here that show specifically how to calculate these numbers, and I'll go through an example next. But I also want to mention that we have a blank worksheet here where you can put in notes, or you can take a screenshot of your own financial statements and place them here so that you can remember how you've entered in or where you've taken out numbers from your financial statements. Before I show an example, I just want to give Lisa a chance to see if there's any pressing questions for me to answer right now. If not, I have a poll question that I'd like to launch. But Lisa, are there any specific questions I should answer?
I think we can wait until the Q&A portion for the questions that have come in so far.
Okay, thank you. Well, in that case, would you mind putting up poll question number 1?
Sure. And here it goes.
Thank you. So this poll question is asking whether or not, so these 6 indicators that you've seen, operating ratio, debt service coverage ratio, do you currently calculate those ratios and track them over time? And do you have specific targets that you're trying to achieve with those indicators? Do you know that you want your operating ratio to be above 1.1, for example? Do you have a debt service coverage ratio target? So if you can go through, just answer, yes, we have targets, and they're actually documented in a formal policy that the board has approved, you would answer A. Or you don't have a policy, formal policy, but you're tracking the numbers and you have some kind of unofficial understanding of what targets you're aiming for, you would choose B. If you only have a debt service coverage ratio because your funding agencies are requiring specific and they're looking for a specific debt service coverage ratio, then you would choose C. Or no, I've never actually calculated these ratios before, but now that I have this tool, I will. That will be option D. And if you don't work for a utility, you can either not answer the question or you can answer E. Or if you work as a regulator or consultant, feel free to answer in lieu of a system that you are currently working with. And Lisa, feel free to close it whenever you think that we are done taking the answers.
All right, it looks like most folks have clicked in, so at this point I will close the poll and share the results.
Thank you. Thank you. And I actually don't see the result answers. Do you mind reading them out?
Oh, sure. So it looks like 4% chose choice A. Do you want me to read the text again? Or?
I can cover that.
Okay. 19% for B, 11% for C, 25% for D, and 41% for E.
Thank you. So the majority of the systems who answered this question chose D, which is no, we haven't computed these ratios before. So now that you have this tool and you have your financial statements on hand, hopefully this tool will help you do that. Also, if you would like our assistance to help you use this tool, we can provide that assistance free of charge to you thanks to a grant that we have from EPA, but I'll mention that a little bit later on. For other systems, it's nice to see that there are some systems that have specific targets and they have it either documented or unofficially they have some understanding of what these indicators are and they're monitoring these numbers. And I encourage every utility, regardless of the size, to set targets, even if it's unofficial ones, and to track these numbers over time. Especially the over time part is important. That helps systems know whether or not the financial health of the system in general is improving or needs some kind of improvement, needs either rate increases or controlling costs or some regionalization project or something else to help improve health of the financial the fund balance. Thank you very much, Lisa. Would you mind also putting up poll question number 1? Sorry, 2.
Poll question
so
number 2.
I'm going to ask. Thank you. I'm going to be asking everybody in the room to help me actually set these targets. So I mentioned in the key financial indicators worksheet, you can change the targets. And what we have right now for operating ratio, including depreciation, is a minimum target 1.0. Do you believe that that is enough? Do you think that 1.0 is enough of a target? Do you think it should go lower? You don't think that you need to be paying for depreciation? Do you want it to be higher? And keeping in mind that depreciation being used as a surrogate for capital costs might actually be underestimating what your future capital costs are, because you're depreciating assets based on historic purchase prices. So if you purchase asset 20 years ago, the depreciation you're calculating is based on the price from 20 years ago. Well, if you try to replace that asset today, the price has gone up just because of inflation of costs. So depreciation alone often are not enough to pay for or to account for the full value of the replacement costs. But also depreciation assumes that you're just paying for your capital costs all in cash. If you're planning on taking debt service in the future, that depreciation value can be spread out over a longer period of time as well. So just wanted to get a sense from the audience, what kind of a target do you currently set, or would you like to set as the target for operating ratio including depreciation? And I think, Lisa, we can stop here.
Okay. All right,
You
Shadi, so go ahead.
can let me know what the highest 2 numbers are, please.
Okay, so the choice that received the most number of votes is 1.2 or even higher. That received 44% of the votes. And the second choice was 1.10. That received 30% of the votes.
Okay, thank you. That actually surprises me a little bit. I was expecting that everybody on the call would be a little bit conservative and not want, well, actually this is sort of conservative. You're trying really hard here to make sure that the revenues you're generating are enough to pay for O&M expenses and depreciation and also an additional 10 or 20%, which is a fantastic goal to have. Realistically speaking, that might be very difficult to achieve. Based on the examples that, or the utilities that we've worked with, that might be a little bit ambitious for some systems. But I will go with a 1.1 in here as the other half of the people who answer the question chose something lower than that. So I'm going to go with 1.1 for the example and see how the system or how the systems that we'll use in the example compare to that target. Thank you. I'm going to skip poll 3. Would you mind putting up poll number 4, please?
Poll number 4.
So poll number 4 is specifically about days cash on hand. And again, this one is how many days of O&M expenses would you like to ensure that you've got unrestricted cash for? So your unrestricted reserves essentially. How many days of O&M expenses would you like to be able to fund that through your reserves? Do you want to have enough cash to be able to pay 30 days, 90 days, 180 days, 365 days, or even more than that? Do you want to have more than a year's worth of unrestricted cash sitting in the bank, basically? And keeping in mind, these targets, the higher that you go, obviously the more revenue stability or more financial stability you would achieve. But it also means probably higher rate increases for some systems because you try to build up to that level of reserve. I'm not trying to advocate for lower numbers either. Higher numbers are always very good as targets. I just wanted to put this in context of what it would mean if you actually set this as a target for your own utility and kind of the pain that will come along with it too. Thank you.
All right, looks like most folks have clicked in, so at this point I will close the poll. And the results, the number one choice here was 180 days, which received 52% of the voting.
Thank you very much. So yeah, you would, for most of the people who answer that, you wanted to make sure that you have at least 6 months worth of unrestricted cash to be able to pay for O&M, and I think that is actually what we have as the default value in the tool. Thank you very much. The last one, poll number 5, please. This one might be even trickier because this one's asking about the percent of capital assets that have already depreciated. Now, keep in mind that we're asking have already depreciated. So if you go higher in this case, you mean that if you pick 75%, you mean that you're comfortable with the fact that your assets have 3/4 of your assets' life have already depreciated before you're thinking about replacing them. 25% means that you want to make sure that you're on top of things all the time and your assets are never past 1/4 of the lifetime before you've replaced them on average. So what is your comfort level with how much depreciation, and think in terms of physical depreciation, how much of your physical assets have already depreciated before you start feeling uncomfortable and want to strongly invest in your capital infrastructure? Thank you. And Lisa, for this one, I would actually like to hear all 5 answers, please.
All right. I'll be happy to announce that for you, Shadi. It looks like folks are still clicking in, so I'm going to wait just a couple more seconds.
And for those utilities that actually have a target, whether it's documented or unofficial, if you are trying to track depreciation or the percent of assets have depreciated, if you already have a specific number in mind or that you're tracking officially, if you don't mind, could you please post that in the questions box just to let us know. I know it's not a question, but it's just for my own education to know what kind of numbers are actually being used in the field. Thank you.
All right. So the results of this poll, 11% selected choice A, 25% or lower. 28% selected choice B, 35% or lower. 41% selected 50% or lower. 12% selected 65% or lower. And 8% selected 75% or lower.
Okay, thank you very much. So the majority or close majority chose 50% or lower, and more than half of you chose, when you account for A, B, and C together, 50% seems to be where the median is right now. So I'm going to be going with 50% as the target going forward in this tool. So I'm not sure if you just noticed this, but I'm going to switch back. It was set at 35%. And for this example utility, the actual value for fiscal year 2014 was 46%, and it showed up in red, and it showed up that red X down here. Switching the target to 50%, switch the color to green, 46%, and also show the check mark that says, yes, we achieved less than or equal to 50%. And if you look at the graph, then right now they actually appear at the 50% line. They are doing better than that target, but they're getting close to it as well. Thank you all very much for all this information. I'm going to be using it going forward. So I'm going to pull up, there were a few utilities that have volunteered to share with us their financial statements so I can use it for this webinar as an example. I'm going to go through at least one of them. Hopefully we'll have time to talk about a second one. And we'll show an example of how to actually pull the numbers out of the financial statements and use them into, put them into the model itself. So I'm going to pull up right now Livingston County Water and Sewer Authority in New York. And this is their financial statement for fiscal year 2014. So it ends December 31st, 2014. When you scroll down, everybody's got different templates and different styles of reporting numbers. You're mostly following GASB rules, but there's some flexibility to some degree in how you report these numbers. You will find in almost all of them, I think this is the right page, a statement of net position, followed by statement of revenue and expenses and change in net position, and then statement of cash flows. We need all three of those for the tool, as well as a depreciation schedule, which shows up in the notes section. I'll come to that next. So in the statement of net position, actually let's go switch to the tool. And in the tool, we're asking for operating revenues first. And operating revenue is key number one. And we have a cheat sheet here that says for line item number one, total operating revenues, you need to find out from the statement of revenues, expenses, and changes in the fund net assets. So let's go to the statement of revenue, expenses, and change in net position, which now is new. That's a new title. And you'll find total operating revenues listed as one of the first things. And we're looking for the total. As long as there's nothing in here that is revenues that don't generally go to the utility for any reason, hopefully that won't be reported this way. In general, you'll find total operating revenues are revenues that come to the utility. So that $3 million number needs to be put into the tool. So let's start with a blank slate. And you would put in the name of the utility, Livingston County Water Sewer Authority, and put in the date of the financial statement, the ending date of the financial statement that you're using. For this utility, I believe it was December 31st, 2014, and by doing that, the tool automatically recognizes 2014 as the last fiscal year, and it's asking for the 5 years prior to that. If we had done 2015, then the tool automatically updates that. So we said that the number is, oh, I got it in the wrong worksheet. It's $3,031,241. Total expenses, operating expenses, shows up down here. And total operating expenses is the number that includes depreciation. So when we're asking up here for total operating expenses, this is the one that includes depreciation. So just straight out of the financial statement. And that number was $3,444,639. We also asked for depreciation next. So we find that under the operating expenses as a line item, $963,000. So I'm going to put that in. And it's $370. Next, we're looking for the debt principal payments and debt interest payments. And if you go down here, it will tell you find that in the statement of cash flows. And again, in the example utility, if you click on this, it will take you to there, and it will show you where exactly to find this from that statement. So it's under the cash flows from capital and related financing activities. You'll find principal paid on bond or loan, interest paid on bond or loan. So for Livingston, we go to the statement of cash flows. We scroll down. We find that they've got down here repayments on bond payable, interest on capital debt. These are the two numbers that we need. So I'm going to go back to the tool, drop these numbers in, click on Enter Financial Data. So that's $144,417 and $78,458. Current assets, excluding inventories, restricted cash, and prepaid. And we have some information down here on the right that just remind you to exclude specific numbers. What we're trying to get at here is not your total current assets, but it's your total current assets minus the current assets that you can't really use to pay for short-term liabilities, or you can't easily use to convert into cash to pay for short-term liabilities. So for this utility, if you go back to the statement of net position, their total current assets is down here, but we need to exclude inventories and prepaid items. They also happen to have funds held for others, which shows up both as an asset as well as a liability. So this is just a fund that they have for another governmental entity, I assume, that they're planning on giving it back to that governmental entity. So we're going to exclude that from both the liabilities and the current assets because it's not something that the utility needs to be worrying about. So the current assets is this number, that's $3.5 million, minus the inventory, the prepaid, as well as the funds for others. We don't put each one of these separately into the tool. We actually just use good old-fashioned Excel formulas. So you put in the equal sign and type out the numbers that you need. So in this case, it's 3,576,533 minus 9,591, 61,091, and 30,123. So this is the current assets that are available to pay for liabilities without having to dip into inventories or prepaid items. The liabilities part, again, it's usually straight out of the total current liabilities, but we're extracting anything that's either a deposit, refundable deposit, or bond anticipation notes, or in this case also the funds held for others, because again, we're taking it out of both the liabilities and the assets. So it's 479,620 minus 30,123. The unrestricted cash and cash equivalents comes as the first line item under current expenses. So it's just purely this number, the $2.6 million. And then the accumulated depreciation and depreciable capital assets comes from the detailed notes on capital assets. If you scroll down, you'll find a section that will usually show you the depreciation calculations. It's actually right up here. It will show you what the value is of the depreciable assets, how much was depreciated already. In Livingston's case, I think it's page. I have to find it. This is it here, right here. I'm going to zoom in. So in fiscal year 2014, their depreciable assets value at the end of the year was 37 million, and their total accumulated depreciation for those assets was 13 million. So let's plug those numbers in real quick. This one I actually have to, there you go, found it. So we want the accumulated depreciation of 13,697,759 and 37,610,549. Okay, so we've entered in one fiscal year. You can do the same thing for all of the years. I already have that entered in, so you don't have to watch me type all these numbers in. So there's the 5 years for Livingston. And we said that we want to have a ratio of 1.1 for operating ratio including depreciation. So I'm going to assume that you want something higher than that excluding depreciation. If 1.1 for including depreciation, maybe we're aiming for 1.25. It might be that you want something different as well. For debt service coverage ratio, I'm going to go with 1.2, assuming that's what the bond covenant says, but usually maybe you'd want it a little bit higher, so let's go with 1.3. I think we said that we wanted the days cash on hand to be 180, and we wanted the depreciation to be about 50%. Okay, so we've entered in the targets. So let's see how Livingston their financial, their water fund compares against all of these targets. Looking at all six graphs at the same time, you can see that they've achieved pretty much all the targets except for the operating ratio including depreciation, which again is not uncommon, we found, for small systems. And this is a system that serves about 7,000 people, so fewer than that counts. So it's really hard for small systems to be able to generate enough revenues to pay for O&M expenses and capital, but they also need to. In this case, we set the target higher than 1.0. We set it to be I think it was 1.1. and they managed to achieve a ratio of 0.88, which compared to a lot of other systems their size, I think that's actually relatively good. But if they don't already have a capital improvement plan, and they don't already know how much capital funds they need to be setting aside every year, then this dial shows that there's a little bit of room to improve on generating more revenue to set aside funds for future capital costs. Again, assuming that those capital costs are going to be paid for in cash as opposed to in a mix of cash and debt service. Their O&M, their operating ratio pays, or their operating revenues are paying for O&M expenses and more. We set the target about 30% higher than what O&M expenses are. So they're managing to achieve that. And the trend line is not really going down or up, so they're doing pretty well. They're balancing their budget. They have a little bit extra in addition to O&M expenses, and that seems to be generally the trends for them in the past 5 years, which is a good sign. It's a slight decline, but it's nothing too drastic. Debt service coverage ratio has started off really strongly and then has declined over the years. So, but they're still on a very strong note. Their ratio is 2.5, 2.49. So they're doing very well compared to the target of 1.2 or 1.25. So again, they have some room to, if that continues to go down for another year or two, it might not be much of a problem, but unless they're raising rates at some point in the future, eventually this ratio might drop below the target. Quick ratio, they have enough assets to pay for their liabilities 7 times over. So at the end of that fiscal year, they had enough cash, enough unrestricted assets to be able to pay for their current liabilities and really not be concerned about any kind of short-term liquidity issues. And that's also stayed kind of stable over time. Days cash on hand, we set the target to be 180 days. They actually ended up with 333 at the end of fiscal year 2014. And you can see that in the past 5 years, they've been averaging, somewhere close to 300 and almost a year's worth of days cash on hand. So they have enough unrestricted cash to pay for a year's worth of O&M expenses without worrying too much about significant declines in revenue. So that's a very positive sign for them. And then the percent of capital assets depreciated, again, downward trend, but not very strongly, and they did better than our target. We set a target of 50%. They did 36% at the end of the year. So looking at all 6 of them combined, we can see that everything looks good. I mean, if I'm running this utility, I'd be very happy. So kudos to Livingston County Water and Sewer Authority. The one question mark would be, are they absolutely sure that they're generating the revenue that they need to pay for the capital investments that are be coming up soon? If they have a CIP and they can look at those numbers and see if the revenues, the net revenues they're generating are enough to pay for their capital projects. If so, that's great. But if not, then just looking at depreciation alone, it looks like they might have to raise rates a little bit in order to achieve that target. Even if we drop the target down, I believe, to 1.0, I don't believe that they've managed to achieve that target in the past few years as well. Okay. I'll take some questions right now, and Lisa, how about we start with 2 questions?
Okay, sounds good. First question is, will the spreadsheet work if you don't have all of the data? For example, will it calculate the operating ratio even if I don't put in the information needed to calculate cash on hand?
Excellent question. Yes. So the tool will automatically, let's say that we don't have data for current, actually for all of these, the assets and liabilities. And you'll see that it manages to calculate the ratios for everything else that does not require that data. Up here, you'll see that we can't calculate the quick ratio, we can't calculate days cash on hand, insufficient data. But everything else is being calculated, and the graphs are shown for the ones that have it. In fact, if you don't have a specific year, the tool will also calculate the ratio and show you the graph. It'll just jump over that year that you're missing from data. So,
wow,
question.
That's pretty nifty. All right, this question's about depreciation. When do we start calculating the depreciation? At construction/engineering, or when we take possession of equipment? Are engineering fees included?
Depreciation, I believe, is when you, actually that is a good question. I'd like to follow up with that person actually by email. I'd like to know a little bit of the context. I personally don't know the answer to that question, but my colleagues do know, so I'll have to come back to you on that. So good question.
Okay, great. We have time for one more, Shadi?
I think so.
Okay, this one I thought was pretty relevant. Did any of the years have an increase in rates in the example?
We did not collect information on the rates for these utilities, but I did talk to a couple of them, and for the example utility that I haven't yet shown, they did have rate increases. I think they raised rates about 1.5% or so, but the two utilities I'm demonstrating, I haven't spoken to them directly, so I don't have their rate information as well. But you would normally notice that the revenues, if you see the operating ratio continue to decline steadily, that usually means that the rates have not gone up.
Okay, well, I think that's all the time we have for questions for today. Before I let everyone go, I just want to mention that in the follow-up email there will be a link to a evaluation. If you could please take the time to fill that out, that's really helpful for us in planning for future programming. Let us know what you thought of today's webinar. And on behalf of the EFC Network, I want to thank you all so much for tuning in today. We hope that you found this webinar valuable, and we look forward to seeing you at future trainings and on future webinars.